Americans cut their spending in April 0.2%. That is the biggest drop in nearly a year. The European Union is urging its members to test wheat shipments from the U.S. for genetically modified grains. Japan halted shipments of certain types of wheat from the U.S. after inspectors discovered an experimental grain that is not approved.
It starts with silence. No orders, no calls, just the low hum of grain silos baking under the August sun. The flatlands of Kansas stretch for miles, glowing gold, dust rising from idle trucks.
Farmers do their best to harvest grain with moisture below a certain level, and modern combines can even track this data in the field.
Drivers lean on their doors, staring at the same news. Their wheat, once in demand across the globe, has been refused. And this isn't just about crops. It's about what happens when a powerful country starts losing ground, not in war, but in trade. If it can happen to American wheat, what else could follow? Stay with me, because what's happening here is bigger than the bread on your table. Far away, at a busy port, an inspector shuts his clipboard with a thud. The wheat isn't rotten, it's not bad quality, but the deals are gone, snatched by Canadian sellers who moved faster, sold smarter, and won over the same customers America once counted on. For years, U.S. wheat wasn't just food. It built relationships, kept promises, and quietly reinforced America's influence in the global market. It also underpinned multi-billion-dollar logistics, shipping, and insurance sectors that depended on steady exports to function smoothly. Now, the countries that once lined up for it are walking away without hesitation. This isn't a sudden disaster, it's a steady, quiet erosion of trust. It didn't begin with headlines or big announcements. The change crept in quietly, through silent ports, canceled orders, and warehouses filled with grain no one came to collect. Fields went unharvested, and some farmers, with nowhere to send their crops, plowed them under rather than watch them rot. Others sold at a loss to clear space for the next planting. Storage costs soared as elevators filled, forcing many to rent temporary facilities. The strain rippled through rural communities, slowing local economies and leaving suppliers and truckers short of work. Meanwhile, rural service businesses, from grain elevators to fuel stations, felt the ripple effect. Local schools and community programs reported funding shortfalls as tax revenues tied to agriculture slowed. Families who had depended on steady harvest income faced mounting uncertainty, adding a social dimension to the economic crisis. Even local newspapers began cutting staff as advertising from agricultural businesses dried up, leaving communities not only economically, but also socially poorer in access to news. In some towns, weekly editions were reduced to bi-weekly or merged with neighboring publications, erasing a century of independent local reporting. Adding to the pressure, regional banking institutions began tightening lending criteria. Farmers who had previously relied on seasonal loans to fund equipment and seed purchases found credit harder to secure, intensifying financial strain. Crop insurance payouts became unpredictable due to new risk assessments tied to market volatility, leaving some operations on the brink of closure. In certain cases, delayed insurance settlements meant planting schedules were missed entirely, compounding losses into the following season. In several counties, equipment dealers reported a sharp drop in tractor and combine sales, while repair shops saw more farmers opting to fix aging machinery rather than replace it. The first real warning sign appeared close to home. Mexico, long one of the most loyal and dependable customers, began stepping back. For decades, the partnership thrived on geography and massive trade volumes. But by mid-2025, U.S. wheat sales to Mexico had dropped nearly 40% from the previous year.
Good morning, I'm Clinton Griffiths. There are a lot fewer wheat farms in the U.S. right now. In fact, USDA says the number of wheat farms in the country has declined by more than 40% in the last 20 years.
The space was quickly filled. Canada boosted its exports by over a third, and countries like Argentina moved in as well. Brazil, which had rarely competed directly in this sector, also began offering blended wheat shipments tailored to Mexican milling needs, quietly securing small but regular contracts. Smaller South American exporters also seized niche markets, showing how agile suppliers could adapt faster than long-established U.S. channels. And the reasons went far beyond simple price differences. Mexican buyers had grown frustrated with sudden policy changes, unexpected tariff hikes, last-minute export rule adjustments, and delays at the Texas border that stalled entire shipments. These setbacks drove up storage costs, clogged supply chains, and pushed food prices higher. In some cases, shipments spoiled while waiting for clearance, creating diplomatic tensions and increasing pressure on Mexican importers to find alternative suppliers. Mexican trade officials even warned that over-reliance on U.S. wheat could pose strategic food security risks if political disputes escalated. In some cases, Mexican grain processors developed in-house storage and blending strategies to manage inconsistent U.S. deliveries. This created additional costs for American exporters who were forced to absorb fees for missed delivery windows, further weakening long-standing relationships. The result was a growing perception that U.S. wheat was no longer a predictable partner. In contrast, Canadian exporters provided steady terms, accurate paperwork, and on-time deliveries. Grain facilities in Manitoba were upgraded specifically to meet Mexico's inspection standards, allowing cargo to pass quickly. They also invested in Spanish-speaking customer service teams and 24/7 shipment tracking, giving Mexican buyers more visibility and confidence. Some Canadian ports even adjusted loading schedules to match Mexico's peak seasonal demand, a move that strengthened their position further. By mid-year, Canadian wheat exports to Mexico had risen by 37%. Meanwhile, in the U.S., blending plants near the border shut down, and farmers cut prices by up to 20% in a bid to keep some business. But orders kept dropping, showing this shift was not temporary. Analysts noted that long-term relationships in agriculture were increasingly shaped by reliability rather than historical ties. One of the most overlooked shifts has been in the way trade deals themselves are now structured, where once a handshake agreement and a long history were enough to secure annual contracts, today's buyers are demanding detailed performance clauses, penalty provisions for missed deadlines, and real-time tracking guarantees. Many of these changes were driven by disruptions during the pandemic, but they've since become permanent expectations. Canada, Australia, and even emerging exporters in Eastern Europe have already adapted to these terms. By contrast, U.S. exporters, many of whom still rely on traditional paper-based processes and fragmented logistics networks, have been slower to modernize. Even shipping companies are quietly changing their priorities. Container firms and bulk freight operators have begun offering preferential rates to suppliers with strong on-time records, knowing that repeat contracts mean steadier business. Canadian exporters, able to meet these benchmarks consistently, have secured better freight deals, making their wheat not only more reliable, but sometimes cheaper to ship, even when the base commodity price is similar. This shipping advantage compounds over time, especially in competitive markets where a few dollars per ton can decide a deal. Another factor reshaping the market is the rise of direct-to-mill supply chains. In the past, U.S. wheat often passed through multiple intermediaries before reaching a foreign buyer, each stage adding time, cost, and opportunities for error. Canadian exporters, by contrast, have invested heavily in integrated systems that move grain straight from farms to overseas processors with minimal handling. This reduces spoilage risk, lowers costs, and makes delivery timelines far more predictable. Buyers in Asia and Europe have responded enthusiastically, locking in multi-year deals with suppliers who can offer this streamlined approach. Behind all of this is a changing cultural attitude among buyers, a willingness to break from decades-long sourcing habits if another supplier can prove they're faster, more transparent, and more aligned with modern sustainability expectations. For many importers, wheat is no longer just a bulk commodity. It's part of a brand promise to their own customers. If their bread, noodles, or pasta is tied to a marketing claim of traceability or eco-certification, they need a supplier who can back that claim with hard data. Right now, Canada is delivering that assurance. The US, still leaning on its reputation, risks being left behind in a marketplace that is increasingly driven by verifiable proof rather than trust alone. Even in niche markets, the shift was clear. Small importers in Central America and the Caribbean placed trial orders for Canadian wheat that quickly became recurring contracts. In Haiti and the Dominican Republic, millers favored Canadian shipments for their alignment with hurricane season logistics, fewer unexpected fees, and better seasonal planning. Europe told a similar story. France, a longtime customer that had relied on the quality of American hard wheat for bread and pastries, saw imports from the US fall to their lowest in more than 2 decades by the summer of 2025. French mills increasingly turned to Canadian grain or even returned to local wheat, despite a poor harvest. The main reason wasn't cost. It was trust in a steady supply. Bakeries reported fewer interruptions in production when sourcing Canadian wheat, which reinforced long-term confidence among European buyers. Some European cooperatives even negotiated collective buying agreements with Canadian exporters to lock in multi-year stability, something US suppliers were unable to match. Some artisan bakers even used the switch as a marketing point, advertising their products as made from sustainably sourced North American grain, with Canada getting the credit. US wheat shipments to Europe often faced delays. Some failed to meet environmental standards, while others contained chemical residues above European limits. Importers no longer felt confident their orders would clear customs without costly problems. A minor paperwork error, sudden tariff change, or political decision in Washington could hold up deliveries indefinitely. This unpredictability also affected smaller European distributors, forcing them to rethink sourcing strategies and contingency plans. This uncertainty extended beyond wheat alone. Some European distributors began diversifying their entire grain portfolios, sourcing barley, oats, and rye from countries with more reliable delivery records. The shift in perception wasn't just about price, it reflected a growing emphasis on risk management and predictability across the food supply chain. In addition, European regulators began pushing stricter traceability standards, requiring suppliers to verify soil conditions, pesticide use, and carbon footprints. Canadian exporters quickly adapted, providing digital certificates and real-time monitoring data. US producers, by contrast, lagged behind in meeting these new sustainability requirements, creating further gaps in competitiveness. Several US exporters admitted privately that they lacked the infrastructure to provide fully traceable data from farm to port, something European buyers now expected as standard. Canadian farms, meanwhile, began partnering with European tech companies to integrate blockchain-based tracking, a move that further appealed to eco-conscious consumers. As frustration grew, Canada stepped in, boosting its share of the European market by more than 40% in just 1 year. France drove much of this demand, and Canadian farms responded by investing in advanced systems, automated quality checks, real-time tracking, and instant verification of grain standards. For European buyers under pressure to cut carbon emissions and prove supply chain transparency, this level of certainty was invaluable. Soon, much of the flour in French bakeries came from Manitoba and Saskatchewan, marking a quiet but complete shift. The adoption of digital tracking also allowed buyers to trace the origin of each shipment, meeting increasingly strict European environmental regulations. Elsewhere, the loss was even faster. South Korea, a loyal customer for nearly 40 years, had built its food industry, ramen, packaged bread, pastries, around US wheat. The partnership endured because it worked. But between late 2024 and mid-2025, America's market share there fell from over 1/3 to less than 17%. The shift in South Korea's market came when the country imposed stricter limits on glyphosate, a widely used farm chemical. US wheat often contained 200 to 400 parts per billion, well above the new limit. while Canadian and Australian wheat averaged between 30 and 70. For Korean buyers, the choice was straightforward. One option meant higher insurance costs, more testing, and the risk of rejection at the port. The other met standards immediately and came with full digital tracking. South Korean regulators also began favoring suppliers with documented sustainable farming practices, further benefiting Canadian exporters. Moreover, South Korean buyers introduced multi-year contracts contingent on strict adherence to quality and safety metrics, signaling a move toward long-term partnership agreements. U.S. exporters, unable to guarantee consistent compliance, were increasingly excluded from tender invitations. This reflected a growing preference for suppliers capable of providing documented reliability rather than historical association. By June, American wheat had all but disappeared from the ports of Busan and Incheon. Canadian shipments arrived on time, and in meetings with major Korean food companies, U.S. suppliers were no longer part of the conversation. Canada had prepared for this opportunity, funding research to develop durum wheat with the perfect cooking texture, building delivery systems that matched factory schedules, and integrating inspections into the supply process. Orders were fulfilled exactly as promised, with no surprises or last-minute changes. This preparation allowed Canadian suppliers to quickly gain trust among food processors who had relied on U.S. wheat for decades. Asian markets also saw new trade patterns emerge. Japan and Taiwan, observing South Korea's shift, began preemptively negotiating long-term contracts with Canadian exporters, showing that perception of reliability was now influencing neighboring regions. This created a domino effect across East Asia, further reducing U.S. market influence. Italian pasta makers valued this same reliability. Grain from Saskatchewan provided the quality they needed without the uncertainty. In Bologna and Naples, more pasta was being made with Canadian wheat instead of grain from the U.S. Midwest. Some Italian companies even redesigned production lines to accommodate the consistent quality of Canadian wheat, signaling a long-term shift. But the first real warning signs had appeared even earlier in the Philippines, a market once dominated by American wheat. For years, the country imported around 3 million tons annually, with up to 90% coming from the United States. That trust began to fade in May 2025. Local distributors started exploring alternative suppliers, and government food programs quietly revised sourcing contracts. A major milling company in the Philippines abruptly canceled a 12,000-ton order from the U.S. and within days signed a new agreement for 110,000 tons from Canada and Australia. The choice made it clear that buyers wanted more than low prices. Even though American wheat was still $8 to $10 per ton cheaper, the risk was no longer worth it. Shipments from the U.S. were increasingly delayed, insurance costs were climbing, and political uncertainty in Washington made importers cautious. Every delivery seemed vulnerable to disruption. The speed and scale of the switch highlighted how quickly global supply chains can adapt when reliability is prioritized. Other Southeast Asian nations, such as Vietnam and Indonesia, began quietly revising import contracts as well. Their governments emphasized suppliers who could meet both quantity and quality standards consistently, further demonstrating the shift from historical loyalty to performance-driven trade. Singapore, though a smaller buyer, began using Canadian wheat in specialty baking sectors, citing better storage stability in the humid climate. At the same time, regional agricultural associations began forming new partnerships with Canadian and Australian producers, providing training programs and workshops to ensure compliance with international standards. This not only strengthened supplier relationships, but also reduced dependency on American exports, accelerating the market realignment. The impact on America's wheat regions was immediate. Freight traffic slowed, inland ports saw fewer departures, and storage facilities in Kansas and Nebraska filled beyond normal limits. Some Kansas silos reported inventories 40% higher than the year before, made worse by a shortage of workers due to tighter immigration rules. In some areas, fields went unharvested, and a few farmers burned unsold grain rather than watch it spoil. Local communities faced economic strain, with grain transport jobs and related businesses experiencing sharp declines. Rural banks in wheat-dependent towns began reporting higher loan defaults, with some family farms forced into early sales or closures. Several U.S. exporters admitted privately that they lacked the infrastructure to provide fully traceable data from farm to port, something European buyers now expected as standard. In Manila, bread prices quietly reflected the shift. Delays in U.S. shipments pushed the cost of pandesal up by more than 11% in less than a month. Once Canadian wheat arrived, prices settled again. There was no public outrage or political debate, just a seamless change from one supplier to another. Consumers noticed the change mostly through stable prices and uninterrupted availability, while the broader market quietly adapted. By mid-2025, the Philippines had joined the growing list of countries turning to other suppliers. Across markets as varied as Mexico, France, South Korea, Italy, and the Philippines, U.S. wheat was steadily losing ground to competitors who understood the demands of a changing global trade landscape. Buyers were no longer focused on the cheapest price; they wanted reliability, consistency, and straightforward business dealings. The shift reflected a global trend where performance and predictability were valued above historical loyalty. The problem went deeper than temporary delays. It was a shift in how American wheat was seen. Once considered the global standard, it no longer had the same reputation for dependability. Policy changes, regulatory issues, and irregular delivery schedules made buyers cautious. Meanwhile, Canada built trust quietly by delivering exactly what it promised, every time. This quiet consistency reshaped international wheat trade, setting new benchmarks for what buyers now expected. Across the industry, experts began warning that U.S. producers must adopt modern monitoring, digital documentation, and sustainable practices to stay competitive. Technology-driven quality assurance and transparent supply chains were no longer optional. They had become the standard for global buyers. Regaining this lost market will take more than low prices. Today, success depends on precision, transparency, and steady performance in an unpredictable world. For U.S. producers, the lesson is clear. Long-term relationships are built on reliability, not just cost advantages, and adapting to new global standards is no longer optional. Reliability, consistency, and trust are what truly keep buyers coming back. Countries that once depended on American wheat have already turned to new sources, and regaining their confidence won't happen overnight. It will take steady performance and proven results, not promises or slogans. That's it for today's story. Thanks for watching, and don't forget more deep dives into the forces shaping our world.